So, Smith City Group, what we're going to talk about today. I'll give you a little bit of a background on the retail market we operate in, a little bit of background on Smiths, a little bit about who runs the business. It's relevant to making an investment decision. You've got to trust the people. And then I'll talk a bit about our business profile and then our go-forward strategy, what makes us different from our opposition. I'm expecting to take probably less than the half an hour that I've been allowed, but hopefully that'll give people the opportunity to ask a few questions at the end. So, the retail market overview. Retail market in New Zealand is basically in three key areas. So, you have the necessity products, which are obviously power, food, supermarkets, fuel, anything that you need around the home. And that's dominated by the two big players in terms of Progressive or Countdown versus the foodstuffs, Pack and Save, New World, etc. Then you have your discretionary area, and the discretionary area is what we would refer to as small ticket. This is lifestyle products. This is your jewellery products, your your Briscoe style stores. You don't need to buy the stuff that's there, but it tends to be smaller clothing, etc. It's discretionary, but it's small ticket. Where we operate is in the big ticket market. About 90% of Smith City Group sales are in big ticket. Big ticket traditionally will be appliances, kitchen appliances, furniture, carpet, motor vehicles. That's really the big part that makes up. It's hugely competitive. You've only got to look at the big players in the market. In terms of on the appliances side, you have Hellings and who are part of the warehouse now, of course, Hellings and Harvey Norman. And the furniture side is dominated by Harvey Norman, ourselves, and Big Save. So they're the big three. So we operate out here, and it's a very, very different marketplace to these. It isn't something you're going to go and do and spend money in or spend time in every day of the week. It's a marketplace where you have to capture your customer 2 or 3 times a year, and price is a key element in terms of your go-forward position. So that's the retail market overview. Smith City, we are a Christchurch-based business, as I said. We were founded in 1918, so it's got 95 years of history. Started off on the same premises we occupy in Colombo Street today. Started off as an auction house, went through some major changes over the years. In the 80s was really when it started to move heavily into the furniture and appliances game, and it's carried through till now. We consider ourselves an integrated retail, finance and property company. In other words, there are 3 parts to our business. The first is the retail side, and I tried to just very quickly tell you the market we're in. Our competition are Harvey Norman, Big Save, Hellings. They're the big 3. Farmers in some areas. We are one of the smaller players relative to the size of those guys. One of the key points of difference that we have, and I'll talk about it a little bit later on, is we own our own finance company. We do not raise money elsewhere. We have a funding line from the ANZ Bank. We have a $75 million funding line, 60 million of which is drawn down at this point in time. We finance our own transactions. So if a customer comes in and deals and buys on terms, they deal with us all the way through. We don't put it out to GE or any third party. That makes us totally unique. So gives us a USP, and I'll talk a little bit later on about how we try to use that in the marketplace. Core business, everything is around retail. We don't go and finance mortgages or rural banking or whatever. It is only for our own customers. We're not looking at competing in that space at all. The property side, 2 sides to our property. One is the property ownership. We own our property in Colombo Street, and we've done some property developments on the way through, and I'll talk a little bit about that. But we are a retail, finance and property company, but everything is around retail. If we don't make a retail sale, we can't finance it. If we're not operating in retail, there's no point in owning a retail store in Colombo Street. So the centre of it is there. Turnover was 220 million in 2013. We got net assets of 46 million. Market cap of 34. What it means is that we're not profitable enough. At the end of the day, profitability is what what leads to an increased market cap, and everything we're doing is recognition of that fact, and we're moving towards that. We have continued to pay dividends all the way through. In the last 12 months, we paid 3.5 cents, which was a gross dividend yield of just a fraction over 5%, on yesterday's share price of 65 cents. So that tells you that, again, if we lift earnings, you lift dividend. If you lift dividend, you lift market share. You lift market price. That's the key that you need to be interested in. The share price has been growing from back in April 2012. Deliberately chose that as our starting point simply because it was after the earthquake. I mean, at the end of the day, Christchurch has taken a bit of a pounding, and so a lot of our time. But since April 2012, we have seen that share price recover. And as I say, it's a bit of an interruption when your head office falls down. So that's really where we're at. So that's the sort of background picture, if you like. Just going back, so let's have a look at the governance for a start. Let's make sure that you know exactly who's running the business from a governance perspective. Our chairman is a guy, Craig Boyce. Craig was the previous CEO of Smith City. He's an experienced businessman. He's chairman of Orion, which is the power company in Christchurch. He has been a past chairman of TVNZ. He's been a past chairman of Christchurch City Holdings, which is the Christchurch City Council property owning company, an investment owning company. Craig is currently on about 7 or 8 different boards as we speak. He is the chairman of Datacom. It's probably the biggest company he's involved in as at today, plus the Orion Power, and then Smiths has been one that he's been involved in for a long time. John Dobson is our deputy chair. John has been involved in the business since 1993-94. He's ex-Marrick, actually. Marrick being mentioned before that was when he was a full-time executive. So he's been involved in the finance game for many, many years. You know, very astute in terms of hedging policies, those styles of things, very conservative actually in his approach to lending. But he brings the skill to the board, very much the background being in terms of the finance company side. Gary Roloff is CEO of Number One Shoes, and he brings that retail experience and particularly a retail knowledge of Auckland, which I'll talk about a little bit later. But it's actually bloody useful having another retailer on the board, I can tell you. Someone who actually is living and eating and breathing retail all the time, who knows what the Department of Stats are saying to you, knows the regional differences. It's a very useful tool. Sarah Autry is a marketer, actually. She's on the board of EBOS and Blue Sky. She's got a couple of smaller ones that are rurally based because her family are a farming family. Sarah's main claim to fame, if you like, from her working career was she was the leader of the TUI's, billboards. She was the marketing director for DB, for Lion, for TUI. And when they did the ads. And then of course myself, and I've been involved, I was involved with Leemings originally when Noel himself ran it, and I transferred across after Smiths got into difficulties in the early 1990s. We've got 50 million shares. The company's, one of the issues in terms of our share price is a lack of liquidity. About 50% of the shares are made up by 5 major shareholders. Now that has changed a lot in the last 2 to 3 years. For a long period of time, Smiths in the 80s were very successful. They were the largest non-food retailer in New Zealand. They bought, for those with a bit of grey hair in the room, they bought Smith and Brown and Maple. Remember Smith, Brown and Maple in the 80s? They got themselves in the crap big time, and they did end up going into receivership in 1991. In fact, Smiths are the only company to have traded its way out of receivership as a publicly listed entity. So it went through some pretty difficult times. Well, as it came through the 90s and through to about 2006, 2007, the cornerstone shareholders were the directors. So on that board at the time, we had a guy, John Holdsworth, who's the major shareholder in Datacom. So there was John Holdsworth, Craig Boyce and myself were the 3 key cornerstone shareholders, and we owned about 35% of the shares between us. The last 4 or 5 years has seen that quite radically change. Our top 2 shareholders are now totally independent of the business. There's a guy, Carrick Belton, who has 19.98, just that fraction underneath the 20% threshold. He's an Auckland-based private investor, and we have a guy, Don Campbell, through a variety of investment companies that he deals with. He's based in San Francisco. He's up to about 17% now, and then because when John Holdsworth sold out, he sold his shareholding down to 5%. So then you've got John, myself and Craig. What that means, and it's important for in here, this has changed the business. You've now got two outsiders looking very carefully at the business, the results that it's got, its strategies going forward. And that's a very different position to where the cornerstone shareholders are actually the directors of the business. And it's helped us enormously in terms of some of the transitional and changes we've tried to make over the last couple of 3 years. You know, knowing you've got someone looking over your shoulder it's meaning that you've got a complete focus on return to shareholders, on shareholder wealth. There's none of that question about it. It's a bit of an old boys club or whatever. Everything's changed as we've gone forward. So that's the governance. We move through just to come and talk that little bit about retail, the big ticket markets. That's the one we operate in. The key to this slide, you don't need to know the figures, you just need to know one thing, is that the market doesn't grow. From 2008, the furnishings market 1.9 billion, 2013 1.9 billion. There is no growth in the furniture market as such. 2008, 2.4 billion in appliances, 2.6 in 2013. Effectively, you know, a 3 or 4% growth. You're not even covering inflation. We operate in a marketplace where we have no natural growth whatsoever. We have huge competition, and you have to make your own growth. You have to make your own profit improvements. There's no magic panacea, no answer. There's nobody else going to come and do it for you. It is entirely over to your own hands. And you know, even if you go back to the turn of the century, you know, we've seen some changes in the furnishings market. 1.2 to 1.9 billion, and that's good. That has been growth, but as I say, from 2007 through static. The appliances game 1.5 billion in 2001, 2.6 in 2013. The key to that is it's completely different product that's being bought at a completely different unit price. So when you look at what people are buying for their household today, and you think about households having 2 or 3 cell phones, having 2 or 3 tablets, at least 1 laptop, 2 or 3 flat panel TVs, the number of units you have in the house is well over double the value. You know, you've probably got 7 or 8 times the number of units in the house, but the value's only doubled. So it shows you the difference in as the prices have moved as we've gone through. Again, this is all that we do. Where we are in the marketplace, Smith City geographically is not in Auckland, so you may not be aware of the brand, and I'll just talk about that a little bit later. But we're built on quality brands, staff, and locations. We are what we call a full-service retailer, in that we're not a discount operator. It's not a case of dirty floors, you just walk in the store. It's all about service when you walk through. We only sell branded product, provided we can source that branded product. Obviously, the furniture game's taken a bit of a hit in the last wee while. A lot of furniture manufacturing's moved offshore. It's not always possible, but wherever we can, we support brands such as obviously the Fish from Paikel, Samsung, Lazy Boy Furniture, Sleepyhead beds, for example. We only stock Sleepyhead beds. We do a lot of work in terms of our locations and staff. We bring strong call to action advertising. Our problem is that we don't have the share of voice that a Hellings or a Harvey's has. They're nationwide. They're much bigger than us. Put it in relative terms, I'd said we turn over about 220 million. Harvey's are around 650. Hellings around 600. So our closest, but they're backed by a $2 billion warehouse business, and they're backed by Harvey Norman in Australia, which is the largest non-food business in the Southern Hemisphere. So these guys have huge backing, which guys like ourselves and Big Safe have to find our niche as we go forward. And the after-sales service is key to our business. If you're in a Hellings or a Harvey's, it stops at the cash register. It is not a Harvey's staff member that delivers the product into your home. It is not a Harvey's business that you will finance your transaction through. Harvey's will not be interested if you go back and have a problem with your unit. They will refer you to the manufacturer. There is the difference. That is our key. That is, in terms of our retail shop floor, is our key point of difference. If our view is that you will remember the gouge in your wall when the product is delivered a hell of a lot longer than you'll ever remember the price you paid at the cash register. When we deliver, if it's a bed, we'll move the bed that's coming out of the house, we can move it into the other room, we'll take the old bed away. Similarly with whiteware, it constantly amazes me how many people you see taking a bloody great fridge home on the back of their trailer. I just wonder how the hell they think they're going to get it out of the box at the other end. They're not exactly easy to lift out of those boxes. And they've got to shift the old fridge out as well. So our model is more expensive, but our model is much more geared towards repeat business. It's all about the lifetime value of the customer. Hence why we own our own finance company. Ownership of the finance company, retains profit. And we know it's a lot easier to retain profit when interest rates are low, but the reality is it is a profit opportunity. But what it does do, it means we're dealing with the customer all the way through the transaction. Now we used to be financed by Fisher & Paykel Finance, FPF. Most of you would be aware of FPF. And our arrears were always higher than Fisher & Paykel Finance. Our write-offs were less than 20% of F&Ps. The reason being because our whole focus is about the repeat sale. So if someone rings up during the week and says, I'm sorry, I'm going to miss my weekly payment, I've had to take my daughter to the doctors, they can't afford to make 2 payments next week. But they're good, so as long as they keep their payments going through, you just allow them the extra week at the far end. It's all about how you manage the customer all the way through the transaction. And Smiths have been a very successful business from in the South Island because of that relationship they have with their customers. Taking it to new markets is the hardest part, and that's what we're working on now. Property ownership. We own the building in Colombo Street, which probably there were times over the last wee while we wished we hadn't, but it's over the years. It is still the home of the business. It's our second largest store by turnover, and it is the heart and core of our business. But property development is interesting too, because we can leverage our strength as a tenant. We've done several transactions where we've seen an opportunity. It's an empty building. We can go in, we can develop it to our own requirements, and then you put it back onto the market as an investment at a realistic market rental. We haven't done any since 2011 for obvious reasons in terms of focus, but we're moving forward. So that's why we consider ourselves an integrated business. In terms of retail, I said we're small compared to our major competitors. But the model we have of having appliances and furniture in the store together, we believe is the right model for the next 20 years, maybe even longer. It mixes the foot traffic that's generated by low margin computer products with the higher value, bigger product, home-based products. So our profitability comes out of whiteware, bedding and furniture, but our foot traffic and our customer relationships and our lifetime relationship with the customer comes through the fact we have a significant number of other products in our portfolio that bring people into store. We do have the Smith City chain is 80% of our business. Alongside that, we have a small appliance business, LV Martins in Wellington we own. LV Martins in Wellington should be a brand that a lot of people are familiar with, and a brand in the South Island called Power Store. They are appliances only. They sit alongside Smiths. They help give us a little bit of scale in terms of our buying in the furniture market. They're not hugely profitable, but at the same time, Smiths wouldn't be able to compete on a buying from a buying perspective unless we had some relative size. And that's where this buying group of NATA comes into it. We operate, you've got in the appliances business, as I mentioned before, Hellings and Harveys, and then you have the next tier of brands below that are JB Hi-Fi, Smith City and Farmers. And then you have the independent chain 100%. We buy collectively through a buying group called NATA. That effectively takes us to be relatively the same business, the same size business as Hellings or Harveys. So when it comes to buying, which is what appliances are all about, that association is hugely important. As I said, we've got our focuses on the furnishing side, the full service side. In terms of furniture, and I made the comment before about furniture, so much of it these days is manufactured in Asia. Even a lot of furniture that was previously branded, such as Lazy Boy, it's still manufactured in Asia. We bring all that product into Christchurch, and we have a large distribution network in Christchurch, fully MAF accredited, etc. And we distribute back through to the North Island, taking advantage of backloading rates. But it is still an area of our business. Logistics is still an area of our business, which is one which is hugely expensive and one we're working very hard on in terms of improving our efficiencies. The key way going forward, two key areas for us going forward. One is obviously the internet. We are very, very cognizant of the impact that the internet is having in certain key areas. It's not really having it in furnishings, I have to say. We're not seeing huge amounts of product being sold on the internet. However, it is very important for customer research. You know, people are now sitting at home, going through websites, looking at various products, doing their research. Quite often, probably more so in the appliances business than in the furniture business at the moment, but that's going to change. And the ability to use technology in store, where before you used to walk in and there'd be a lounge suite sitting there and you'd have a little wee scrap of cloth and you'd be saying, well, that you can have it in those seven colours and away you go. Those days are gone. You know, the ability, you've got to be able to show the colour, what it's going to look like actually by using computer technology, and it's got to be bloody right. You know, you can't have it 2 or 3 shades wrong on the colour scheme. Interestingly enough, just on that, for example, the use of technology in this import program. I'll be a few years ago, probably 6 or 7 years ago, some genius with a beard and glasses in our business decided it would be a good idea to try and do their importing a little differently, and they decided, they being me, decided that we would have a distribution centre in Nelson and one in Tauranga and one in Christchurch. And this would be a great idea because the product would come in and we could just distribute it locally and we'd save freight. That was a bloody disaster. Because you had these guys, the guy in Invercargill was selling the product that arrived in bloody Nelson, and the guy in Tauranga wasn't selling enough product, so we were ending up with stock holdings up there. But you learn from everything. And in here, what it told us was we had to use technology. So at our cash register today, you go in and you have that lounge suite and you say, right, it's in that leather colour, that's the one I want. And we say, right, okay, we can go in and reserve that. Our salesperson can reserve that. They can look up, they'll know exactly what stock we've got on water in each individual container, and it can say that particular lounge suite is now yours, it's been reserved, it will arrive into Christchurch, and we will be distributing it to you. We will ring you the day it arrives and is devanned in Christchurch, and we will give you a time when it will be delivered to your home. And we stick to that, and we have a KPI now that 80% of our lounge furniture should be pre-sold before it hits Christchurch. It was an expensive lesson to learn, but it's actually over the long term probably got us to be one of the most efficient, and we've cut our waiting time for lounge suites from an average of around 6 weeks now to under 2, where we're able to track that with the use of technology. So we are very interested in what we call an omni-channel retail offering. That means, as opposed to multi-channel is where your online site operates completely independently from your retail store. Your pricing could be different, your products could be different. We do it the other way. We say no, it is actually just an add-on to our store, so that you look up on there, the prices will be the same, the product will be the same, the specifications will be the same, and you can walk off that and walk into our store, and in around 70 to 75% of the time you'll find that product sitting on our shop floor. Can't say 100% because you have the odd stock out, but target to be 100%. Means we lose a little bit of an opportunity to some degree, particularly say at Christmas time when you see Briscoe's out there offering $5 delivery, and they'll have everything from God knows to what are available on their website where they've just bought it in for Christmas. It's basically another retail store. Ours is done differently, and no apologies. We use our website for different reasons. If we ever need to, the technology is there where we can just swap it straight into being an online selling tool if we want. And the other thing that we're working on at the moment is if you go to a Hellings store, Hellings at about 600 million are the only true nationwide appliance chain. They have a very large non-retail part to their business. So flybys, they sell obviously used flybys, but their biggest thing of flybys is redemptions. If you've got flyby points, you have to redeem them, you redeem them through Hellings. They are the only ones that can offer for the insurance companies a national opportunity to, say for IAG, to be able to come up to a national price. If someone's having a claim, they can ring into Hellings, they lodge what they need, and they can go to any local Hellings store. Commercially, same thing. You know, they've got commercial reps through the country. So probably 20 to 25% of their business actually isn't done through their bricks and mortar. Now what we're saying is that we've got some opportunities through our non-bricks and mortar channel. So we look at commercial a little bit similarly to the way we look at our online. So it's taking advantage in Christchurch, particularly Christchurch and Wellington. Wellington because the LV Martin brand, strong, established, has good working relationships, particularly into government departments. In Christchurch, we tried to find a niche. So for example, you look around and think, oh yeah, there's going to be great opportunities. Ridges Hotel just opened up in about, with about 120 rooms or some damn thing. You're not going to get into those. What you're going to get into is the number of motels that are currently booked 7 days a week, where they've booked them out 7 days a week. They've got 2 guys to a room. It's with commercial builders. 2 nights or 1 night a week at least they're going home, so the room's actually sitting there empty, but they've got it booked for 7 days to be able to keep the booking. They want us to go in at the weekend and do the refurbishment, putting in a new bed or putting in a new TV or a new fridge, whatever it might be. They want that to be done at the time when they're empty, so they're not losing revenue out of it. They don't want to have a room down for 2 days. So we've found our niche in this after-sales service. We're able to go out and do that to the local market. So again, it's not a case of going out and trying to compete with Hellings. It's actually learning from Hellings and saying, a bit like the guy said in the previous thing, you've got to find your niche. And that's going to be quite a key part of our business over the next 4 or 5 years. So that's our retail business. The financing side I mentioned before, I'm sorry, I probably am taking a little bit longer. Financing is all about the customer relationship. It's keeping our relationship with the customer. We'll be the good guy. You can argue, oh, what if they don't pay? If they don't pay, they have 2 reasons. One is they can't afford to pay, but they're good people, in which case you work with them, they'll never forget you. The other one is if they can't pay, then really, in all honesty, you don't want them back as a customer anyway. You're actually going to cut your losses. But in reality, but 99% of New Zealand people pay their bills. Trust me, they do. It's just you've got to treat them right. We are New Zealand domiciled and managed. We use that a lot. I can't say New Zealand owned and operated because I mentioned before one of our 2 major shareholders is now based in San Francisco, so we've got to be careful. But to all intents and purposes, that is the only damn thing in our organisation that doesn't have black blood flowing through its brain, through its veins. In the finance side, if you just go through, Brian, what we do, for example, in store, you walk in and find, dear customer, the Smith Court Finance logo is a little bit old hat at the moment. Probably one of those things we might have changed if we hadn't had a couple of other priorities over the last couple of years. We'd like you to know that when you buy from us, you're dealing with Smith Court Finance. Smith Court Finance is 100% owned by Smith City. When you do purchase from us on credit, you are dealing with local Smith City staff from start to finish. Just another way that Smith City makes it easier. So we're trying to build that relationship with the customer all the time. If you have a problem, you come back into the Smith City store and we'll solve it. That is hugely different. The bigger, particularly the multinational companies, the Trans-Tasman companies just can't do that. If you've got a Good Guys in Auckland or a JB Hi-Fi in Auckland or whatever, they just can't do that. Property side, as I said, this is the Colombo Street property. 9,000 square metres, 90,000 square feet. It used to be a two-storey building. It's now a single-storey building because the top bit fell down, but we've got it back up and trading. The main thing to think of here is it is on our balance sheet, but this is the one, the property development side, is we are able to, if we do look to move store, one of our first options will always be to say, is that a development that we can do ourselves? And because as a tenant, you're getting ripped off that many times by bloody landlords and insurance companies and whatnot. You want to get a little bit back if you can, and the only way you can do it at times is to try and take either a share or all of the development profit on the way through. So we do that, and I do have to say we haven't done it since 2011, but we will be looking at doing those as we go forward. So where do we go? Why would you be interested in Smiths? Given you, in terms of governance, etc., I've told you what we do. We were only in the South Island in 2004. In 2005, we purchased a business in the Upper North Island called Meikles, which we rebranded to Smith City. In 2006, we bought 80% and then took over the final 20% of LV Martins in Wellington, and we've increased the Smith City footprint as we've gone through. In a business, in a market which is static, to all intents and purposes, it's static. And where you believe you're running your business reasonably efficiently and at a reasonably low cost base, the way to increase your profit is to increase your sales. The way to increase sales is only twofold, well, three effectively. The first one is to increase market shares in the markets that you're in. The second is to actually open geographically. The third is to find new markets, as we're doing, say, with the commercial and the online strategy. But the first two are the two keys to it. In our case, if we look at where we're at, have we got the graph up there? Here we are. In 2013, Smiths, and you don't need to look at it too much, it's in our yellow book, it's in the back page. We operate we've got a good distribution in the South Island, we've got a good distribution in the Lower North Island, we have a good distribution in the Bay of Plenty. There are no names because we have no stores in the Central North Island or Auckland North. Smith City gets a third of its sales of its two major competitors because it operates in a third of the market size of its two major competitors. Relative to those players, we're strong in our own markets. The difference between us and those players is we've still got 2/3 of New Zealand to go. Now that offers its challenges, make no mistake about it, it offers its challenges. The Auckland market is a difficult market. Talking generally, a generalisation from a demographics viewpoint, it is a third Asian and a third apartments. They're not the same third. Probably 40% are a business that we traditionally don't do business with, and which has different tastes and different requirements. We deal with people who live in houses, who want a lounge suite, and they want a big fridge, and they want a freezer, and they want a bloody beer fridge as well. We don't deal necessarily with small apartments where they want kit set furniture and everything needs to be a lot smaller. So when we look at some of those markets, we know there are some challenges for us, but our path forward, our reason for standing here talking to you as analysts and investors today, is that Smith City has a growth strategy. It's been punched in the face once, but boy, it's going to take it forward. We know to get to the profitability and the dividend, and hence the share growth that is there, and it's there at the moment because we're already trading at a discount to net assets. We need to grow, and we need to grow profitably. And we have a good board that's overviewing it, and we have two independent shareholders who have nothing to do with running the business at all, who own 39% of the business, who are watching us like a hawk. We've got to get it right, and we will get it right.